we're still above those pre-pandemic levels.
I think the labor market, by many measures, is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way, though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens. It's probably will take a couple of years to get all the way back, and that's okay. That's okay. But we do see. You saw today's ECI reading. The evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. Panic on the part of businesses, couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to where it's still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance, and that's what we want to see. And one great way to look at that is what's happening with wage increases, and you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk, the risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here and why we're not rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months, but what's really going to shake out here? What will, when we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. Yeah, we'll look at those. Last year was a surprise.
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE's been running at 1.5%. And there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years, so it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target. It's not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question, we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, right, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case. Then your second question is
is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happened, that would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Victoria.
Hi, Victoria Guido with Politico. Could you talk a little bit more about productivity growth? You've mentioned multiple times about, the level of wage growth that's consistent with 2% inflation. We've obviously seen, you were talking about ECI this morning, in which it's cooled a little bit, but still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute to productivity, and do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about, or do you think that productivity growth will fade over time?
So this is a really interesting question, and I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy. And the question will be, what is it that has changed? The productivity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but right now I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force and activity returning and supply chains getting fixed.
Right. So would that be behind why we've seen such strong growth, but we've also seen inflation fall, that maybe there's just a higher level of productivity?
That's
right
one
now?
way to look at it. Yeah.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
So when we think about, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. We have a built-up set of cities, and people are moving further and further out. So there hasn't been enough housing built, and these are not things that we have any tools to address. But where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So.
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly, not most importantly, mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation in the necessities of life, right away you're in trouble. Whereas even middle class people have some scope to absorb higher costs. So we have to it's our job, it's what society has asked us to do, is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
Courtney.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March. So those questions are all coming into scope now, and we're focusing on them. But we're at the beginning of that process, I would say.
Quick follow-up. Is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, we do. We see those as independent tools, and so they don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet runoff to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Yeah, I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction, and we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to zero, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to zero. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's
Correlated
what we'll be talking
to
about
the
at March
S&P
meeting.
500 right
A
now.
whole range of issues will be briefed up, and the committee will get into all of the issues that will be arising over the course of the next, let's say, year or so.
Greg.
Thanks, Greg Robb from Market Watch. Chair Powell, I want to change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often, and many Republican candidates had said that they probably wouldn't want to give you a third term. So I wanted to give you a chance to talk about that. Do you want another term? You've had on the Fed. What's your stance on that?
I don't have a stance on that. It's not something I'm focused on. Focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months. And you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data, If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that the 6-month inflation numbers, which are very close to 2, were in PCE world, if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point, is we're trying to get comfortable and gain confidence that inflation is on a sustainable path down to 2% or toward 2%.
Daniel.
Hi, Chair Powell. Daniel Davis, Agence France Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years. But nonetheless, that's been the case, and we've asked ourselves why that is. And one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But you're right, it is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Thank you for taking our questions. Brian Mena, CNN Business. Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data are subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy, and I always feel like I spent most of my life in the private sector looking at individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone. That in all their districts, they're talking to not just the business community, but the educational, medical, all nonprofit community. They have arms into all of that, and so when they come back, that's what goes into the beige book. But that they come back, and what each reserve bank president does is during the Outlook go around, they'll say in my district, and they'll talk about 100 conversations. They won't talk up. They will give you input based on 100 conversations that they've had with people of all different walks, and I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them note a slowing economy based on what they've heard from their district?
Yes, I mean, if you look back at the last, not this beige book, but the one before, it was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing not in every district, and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And also, perhaps, are you worried at all that the economy is maybe a little too strong right now, and that inflation could come back at some point?
I'm not so worried about that. It's again, we've had inflation come down without a slow economy and without important increases in unemployment, and there's no reason why we should want to get in the way of that process if it's going to continue. So I think declining inflation, continued declines in inflation, are really the main thing we're looking at. Of course, we want the labor market to remain strong too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
Welcome to Closing Bell. I'm Scott Wapner here, Post 9 here at the New York Stock Exchange. The first Fed meeting of the year officially in the books, along with the first news conference, of course, of Chair Jay Powell. The question on everyone's mind going in, when will the first rate cut come? Clearly, the chair was non-committal on that. He did say in his comments a few moments ago that it will likely be appropriate to begin reducing rates sometime this year, that the hiking cycle most likely done. The money line of the whole day seems to be that question he got about a March cut in which Chair Powell said, quote, probably not the most likely case. Well, stocks didn't like that at all. They sold off pretty quickly. That's pretty much where they sit now. You can see we've got 1% plus declines for the S&P, the NASDAQ, and the Russell. Dow has gone negative by about 2/3 of 1%. Think the bottom line, cuts in play. Who knows when? Who knows how many? That's probably just the way Chair Powell wants it to. So on that note, let's bring in Jeffrey Gundlach. He is the CEO, CIO, and co-founder of Double Line Capital. Joins us for our first Fed meeting of the year. Jeffrey, welcome back. What's your assessment of what you just heard?
Well, you're right that the money line was we're not cutting in March as a base case. And I think that that's going to be the case because we have an inflation model. I've talked about this after every Fed meeting. And we knew that inflation was going to come down. But for now, we think there's going to be a stall in the inflation rate coming down. And that will probably mean that the market isn't going to get the Goldilocks picture that it was euphoric about a couple of weeks ago. And that is that the Fed's cutting, it's going to come soon, it's going to be quickly. That's not going to happen. So I think risk assets got to a very high level of enthusiasm, not just stocks, but things like junk bonds, bank loans, very, very high prices relative to where we've been on average over the past couple, 3 years. In fact, a lot of these markets are kind of back to where we were at the beginning part of 2022. And so I think that Jay Powell did a really good job of being candid, I would say. There was a lot of less hand waving, I guess, and more statements. And the one on March was obviously the big one that tanked the stock market and got the bond market a little bit less enthusiastic, although the short end is still down significantly in yield. So on we go to the next meeting, and we'll see what happens. But the baseline here is the market can't expect a rate cut in the next 2 or 3 months.
Does March really matter when it comes down to it, as long as even the Fed chair admits they're likely to cut at some point this year? It's the trend that matters more than the date. Isn't that correct?
That is correct. But the market really, not very long ago, was pricing in March pretty heavily. And that led to very high valuations on a lot of risk markets. And the longer that the Fed stays at what is going to be about a 200 or 300 basis point real interest rate on Fed funds, there's risk to economic growth that's going to build as we move into this year. You know, everybody knows that the employment market on the headline establishment survey looks really good, but there were a lot of downward revisions in the last employment report, and the household survey isn't as strong. And there's also data that never gets reported to the extent it should be, which is unemployment data that's reported on a state level. The states do this too. And they have 51 states. I think they have DC in there as if it's its own state. And something like 85 or more % of those 51 state reports have rising unemployment over the last 6 months. So there's a strange mathematical inconsistency that the unemployment rate stays at 3.7 on the national house establishment survey, but over 85% of states report that unemployment is rising over the past 6 months. It almost doesn't seem possible. Now, the states that are not reporting rising unemployment are Wyoming, North Dakota, yes, Texas, I think Pennsylvania, but not California, not Illinois, not Florida, not New York. So I don't know, is unemployment really as low as we think? With continuing claims are rising, that's a leading indicator. Temporary employment is falling, that's a leading indicator. And the quits rate is now in every sector about the same as it was pre-pandemic. So this narrative of there's nobody quitting is just false. It's all the way back to where we were pre-pandemic. So I just think higher for longer is going to weaken the economy, and that's what you hear when March is. Would have to see a big data change, which one should not expect. There's 2 data reports before March, but our inflation model isn't looking for further relaxation in some of the key inflation measures. I just want to say one more thing about inflation, and that is one reason to be optimistic past the next few months on inflation is that the PPI remains negative year over year. That's a leading indicator. And import and export prices, which are my favorite inflation measures because they're not adjusted in any way, those have been negative for a while now and remain negative year over year. So I think cuts are coming, but we're on a delay now, and I think that puts the market in a less euphoric position.
Well, I mean, if you look at the most important metrics on inflation, certainly to what we believe the Fed thinks is most important, employment cost index is falling, expectations are falling, PCE is going well in the right direction. So why not cut as soon as March? The worst thing that they can do is now take too long to cut, like they took too long to hike, isn't it?
I completely agree with you, Judge. I think that's the issue that the market's having in the last half hour or so, is there's risk that has been inserted into the marketplace relative to the Fed, because we were looking for 6 rate cuts based upon the pricing in the Treasury market using the WIRP function, 6 rate cuts here in 2024. And you better get started pretty soon if you're going to have 6. And now it looks like we're talking probably, I don't know, I'll just take a guess that the baseline right now is June on cutting rates. And do you really want to get aggressively cutting in the 5 months or 4 months leading up to the election, the presidential election? I don't know. I'm skeptical that the Fed is as political as many people assume that they are. A lot of people have been talking about that. The Fed's always political. I think it's somewhere in the mix, but I believe Jay Powell is not terribly political, and he's been doing a really good job over the past, I don't know, year now of communicating. It's the dual mandate, and now he's saying it's in balance and so forth, but he was crystal clear that the inflation rate has to stay at a level that resembles 2% or get near 2% and not go higher. And if that happens, there could be some real disappointments. The good news is I don't think it's going to go terribly much higher. And another reason I feel that way is the Bloomberg Commodity Index just remains in a protracted downtrend. The 200-day moving average just keeps dropping, and it's below its 200-day moving average. So that would not be a catalyst for inflation. The last thing I want to say about commodity prices is with all of these tensions going on and saber rattling now with Iran and retaliation and already wars in Ukraine and Israel, it's interesting that the price of oil doesn't really go up. That would be indicative of a weak-ish global economy. We know that Europe is acting like it's in recession. We know that China hasn't been doing well lately. So it looks like the demand for commodities and oil is waning, and it's overwhelming even some very significant geopolitical tensions.
Are you still calling for a recession? Because I thought it was notable where Powell, a few moments ago, rather matter-of-factly said this is a good economy. And yesterday we had Ken Griffin on this network as well. He talked about Goldilocks, the potential of a soft or either no landing, and said the economy is, quote, pretty damn good right now. Are you calling for a recession still like you have been?
Yes, I am in 2024. Yes, I am. And I want to talk about experience in markets. And I've got a lot of it, being at this for over 40 years. And when I hear the word Goldilocks, I get nervous. Because when you hear people saying Goldilocks and everybody in the room nods their head in a north-south direction and everyone says, yeah, it's Goldilocks, that means everything is priced to something resembling perfection, the Goldilocks outcome. When you're in Goldilocks, the problem is, I remember once in the year 1999, there was somebody that I worked with that was very aggressive in NASDAQ type of stocks, and he called the environment at the turn of 1999 into 2000 nirvana, investment nirvana, and I got a chill went down my spine. I said to myself, if this is nirvana, it means it can only get worse. It's like a AAA rated bond. They can only go in one direction. If you have nothing but AAA rated bonds and they're not guaranteed in any way, well, they can only get downgraded, they can't get upgraded. I feel that we're sort of priced for perfection when I hear Goldilocks language being bandied about. And today, Jay Powell took Goldilocks away, I think.
You said a little bit ago that risk assets are pretty extended, and you didn't limit that to equities. You mentioned parts of credit. So what would you do? And I should also preface that by saying that I got a text a few moments ago from somebody who's on my investment committee saying, buy bonds, plain and simple. So what's your read on what the portfolio needs to look like, given what Powell has just done, seemingly taking March off the table, though even non-committal? No one knows, truly. It's 2 meetings, 2 months from now.
I think if you want to buy bonds, you should buy Treasury bonds, and you should buy Treasury bonds like 2 years, 3 years, 5 years, maybe out to 10 years. But I do think bonds remain very attractive with the inflation rate maybe stalling out in terms of its improvement, but likely to stay lower. We have a high real interest rate. But during the months of November and December and the first part of January, we had one of the best credit bond markets ever in terms of prices going up. Even the downtrodden started to rally in December. I'm talking about commercial mortgage-backed securities, which people would break out into hives if you talked about buying commercial mortgage-backed securities back last summer. Even those started to rally a lot. And really, I think in many parts of the credit market, things are overvalued because we've had this Goldilocks mentality. Spreads on investment-grade corporate bonds are in the top percentile of where they have been, which means they're the least attractive, in the bottom decile of attractiveness. Junk bonds, on average, are in 12th percentile. So they've been cheaper than this 88% of the time. And the Fed is not really going to bail out risk assets in the near term, per Jay Powell's own words. So the real interest rates on treasuries appeared attractive to me, particularly if the Fed is staying higher for longer and may, by that process, engineer a lower inflation rate than 2% by the end of this year, which would make bonds, treasury bonds, very attractive and lead to the Fed cutting interest rates. But unfortunately, that may be in the context of weaker economic growth and rising unemployment. So I like cash a lot now. I like defensive bonds. I like cash because I feel like there's just as investment-grade corporate bonds are bottom decile of spread, I feel like risk is really in the top decile now in terms of valuation and problem. So I like cash because I think you're going to get better buying opportunities. I've been talking about emerging market securities, stocks and bonds, but we remain underweight because we want to wait for the recession to come. And those areas have not been doing very well of late, thanks to China and thanks to slowing global economy. So I think you want cash to be able to get into that emerging market trade once the economy slows and perhaps goes into recession. I think globally, There are certainly many pockets of recession at present. But if we go into United States recession, I think we're going to see a buying opportunity, and you want cash for that. And, you can buy the 2-year Treasury. That's sort of a cash surrogate. You don't have to roll it every 3 months. But on the shorter end, you're still getting 5.25 on the 6-month bill, and that's probably fairly attractive. But I would want to have a little bit longer maturity just in case the rates start to fall and you have to reinvest at a lower level. But this is, for me, I'm in a defensive mode. When we talked in the November Fed meeting, I think it was November 1st, I talked about how I was pretty enthusiastic about things. But that has totally repriced since then. And so I'm sort of, the pendulum's on the other side for me at this moment.
It's been a different market. Bear with me if you would, Jeffrey, for a moment. Let me just update our viewers as well. We are almost at the lows of the session, just slightly off. Dow's down about 280. The S&P 500's trading at 48.53. Remember, it was just a day ago where we got the first ever close above 4,900 as we headed into those mega cap earnings. We've given that up, obviously, with this move lower. S&P's down about 72 points. Back to Jeffrey Gundlach in just a second. Steve Leisman's come out of the room where the chair was giving his news conference. Steve, it's just so interesting because the March commentary from the Fed chair clearly upset the market. It almost feels like a Fed chair who's 9/10 of the way there of wanting to cut rates. He just needs one more jolt of inflation confidence to truly get there. And maybe March is just simply too soon.
Yeah, I mean, Scott, very dramatic moves around stocks, around bonds, around Fed fund futures. I'll just show you one example of how things have been moving. You've been following the stock market. Look at the outlook, the probability for a March rate cut. It's come down 36%. We had been, I don't know, between the meetings as high as 80%. So hopes dashed around the world for that early Fed rate cut. But Scott, I have to tell you, I was somewhat amused because I didn't think Powell was going to answer that question as detailed or as specifically as he did, because the story is this. I thought, like he said, he didn't say this, but I thought he could have said, if you haven't listened to everything we've said between the meetings, if you didn't listen to what we said in the statement, and if you didn't listen to what else has been going on, we're not cutting in March. Let's hear the sound from what Powell said, dashing hopes for that March rate cut.
Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case.
Yeah, and Scott, I'll just leave it there, except for, I'm sorry, but that is consistent with things that the Fed chair has been saying, and the market has been listening to some extent, but not nearly as much as perhaps it should have been.
He was, though, as you said, more explicit. Let's say that. He was more explicit than perhaps some expected him to be today, and that's one of the reasons why you've got a Dow down by more than 300. Steve, thanks as always.
Let me just add, Scott, I think that one of the things he said in response to the Nutri-Weight question was the idea that he does expect weakening in the economy. He says the strength we've had so far is supply and demand coming back in a better balance. He expects weakening, and that is the weakening, I think, Scott, that's going to precipitate the rate cuts.
Yeah, that's a good point, as the many that you've made. Steve, thank you. That's our senior economics reporter, Steve Leisman. I'll go back to Jeffrey Gundlach. Jeff, I thought it was also somewhat profound today and kind of underscored the shift in psyche, if you will, of where Powell and the Fed seem to be. Because it appeared to, I think, everybody throughout the beginning to middle stages of, let's say, this hiking regime that they've been on, that they needed to crack the labor market to get demand down and then ultimately to bring inflation down, to where now Powell underscored a number of times today, we want to keep the labor market strong. That is a change of focus clearly for the Fed. Now they don't think that they need to unravel the labor market clearly to get inflation to target, because I read you where the ECI is going, the cost index, of course, and where the PCE and expectations seem to be heading.
He also said, Scott, that the labor market is largely healed back to where it was pre-pandemic. Not all the way there, but largely there. And I think he's right about that on a lot of the data. And so it would be nice if the labor market didn't weaken, inflation would stay down at 2%. But like I said, 85+% of states say unemployment is up over the past 6 months. I just wonder about all of this. Are these numbers real? I don't know. But the JOLTS numbers used to get a lot of attention, the jobs openings. And people are starting to realize that survey doesn't mean anything anymore, because the response rate to the JOLTS survey used to be 75%, and now it's something like 35%. So is it really comparable to where it was a while ago? Are people dropping out of the survey for I don't know, reasons? What reasons would they be? I don't know. But it's non-comparable. So today we got the ADP number, and I think this is what got the bond rally going today, and what hurt the stock market initially, was the ADP data was not great. Now, ADP data is notoriously non-correlated with the establishment survey that's coming out later this week, but it did seem to move the market because it was a noticeably weaker number. So we'll have to watch what happens there. I expect the unemployment rate is going to go up. I think the unemployment rate is going to end this year higher than the Fed's dot plot as of December. That's what I think is going to happen, and that's going to necessitate lower interest rates. And since we don't have those lower interest rates, even though the 2-year Treasury was down, at 4%, with the Fed funds rate at 5 3/8, that's a pretty negative yield curve there from the Fed funds to the 2-year. It is not meaningless. This is going to have an impact, and the Fed staying higher for longer. I've talked about this for several months now. Staying higher for longer is going to be bad for the banking system. And I noticed that we did have a little banking problem today, although I think it's isolated.
I do want to talk about that, and I'm glad you brought it up because it's exactly where I wanted to go. The level of concern that you would have today around the regional banking system relative to commercial real estate. A couple of bad loans at New York Community Bank, and that stock is having one of its worst days, if not the worst day it's ever had, down more than 37%. This could obviously put pressure on the Fed potentially to move sooner rather than later. How do you see that?
It might. There's plenty of anecdotal evidence that particularly the urban office market in commercial real estate is a real debacle. I mean, there was loans underwritten on post-pandemic assumptions to a valuation on one building of $330 million, and it went into foreclosure and got sold out at $130 million. So that's a big haircut. And these things take time. In investing in the economy, everything, that's why I try to mentor the young people, everything takes longer than you expect. You can see that there's problems in commercial real estate, but it will take time for those things to go from a theoretical loss to a realized loss, and those things are going to be happening. So there's consequences to money printing, there's consequences to higher interest rates. They just happen in slow motion relative to what people have patience for. But that I think is going to be the story of 2024.
Speaking of money printing, I noticed many posts from you of late on social media about the deficit. Do you think markets are too complacent about that today? There was a moment a handful of months ago where it was sort of front and center. Rates had been moving higher on these concerns about funding the deficit and whether all of the supply was going to be able to be absorbed. And we sort of moved past that. As we said, we've hit new highs on the S&P heading into today. So what about that issue? Should it be of greater concern today than perhaps it is?
Yes, it should be, but like everything, it'll take forever. I don't think that the 2024 election will be about the deficit. I do think the 2028 presidential election will be about nothing but the deficit, because the interest expense is going straight up. We've added about $400–500 billion of interest expense per year already, and we have tons of bonds, like 17 trillion of Treasury bonds, rolling off in the next 36 months. And if we're higher for longer, every day we roll these things over, the interest expense is going up, and we're getting to the point where we can't deny it any longer. Medicare admits that it'll be broke in 2030 using CBO assumptions. Social Security admits it'll be broke in 2032 using CBO assumptions, but those assumptions are overly optimistic. They assume no recession ever. They assume real GDP growth that resembles where we are right now. It assumes interest rates lower than what Treasury rates are today, and it assumes a deficit that's smaller than it is already today, even though we aren't in a recession officially. And so if you tweak those assumptions, it's more likely that Social Security and Medicare go bankrupt in the 2020s than in the 2030s. And the last time I checked, we're midway through nearly 2020s. So this is going to be a really big issue. And higher for longer just brings it forward more quickly. And I think this is going to be the defining issue of the next 6 years.
You know, Powell has had the benefit of having, you know, unanimous votes inside that room. There haven't been any food fights, so to speak, about where policy is going to be. Do you think we start to get dissents, and does it matter at all?
It doesn't matter if there's dissents. I mean, it doesn't look good for the chairman, but ultimately it's Jay Powell's decision, I'm certain. And I think you will get dissents. I think you'll get dissents certainly by the May meeting if rates are where they are at that time and left unchanged. I think we'll start to see dissents. I noticed that there were some letters sent by a bunch of Congress people to the Federal Reserve people saying, you know, you need to cut rates now. I'm not sure what that's all about. Maybe they want to get reelected. I'm not sure, but I'm not sure what that's all about if everyone's crowing about this Goldilocks economy.
And lastly, before I let you go, let me ask you about the dollar, because it's another, you know, asset class, if you will, that you've spoken about with me on numerous occasions. You had what was a weak dollar you had expected to ultimately strengthen, which of course it did quite substantially. So how does that play work now relative to what your view is vis-a-vis what the Fed chair said today and what you think they may do?
It should sustain a relatively stable or stronger dollar because the market was looking for rate cuts, and they're not coming, at least not in a couple of months. So I do think when the recession comes, the dollar is going to be very different than it's been in past recessions. In past recessions, it would always get stronger. This time, I think it's going to get weaker because of the policy response to the recession. One thing I want to say, I've for a long time recommended India as an equity asset. The Indian economy is the strongest economy in the world. Their services PMI is over 60. Their manufacturing PMI is basically the most robust in the world. I think that investors should be using weakness if recession materializes and start to doubling up on the INDA, the Indian Equity ETF. I don't have a stake in it because I don't like to recommend things that would be in my funds. But I think INDA is a good investment for people looking to get equity exposure on weakness. It's my number one recommendation for 2024.
All right. Well, that's a good way and a good place to leave this. Your insights are valuable. We count on them every Fed day. I really appreciate your time. We look forward to the next one, Jeffrey. Thank you.
All right, Scott. Good luck.
Yep, you as well. That's Double Line's Jeffrey Gundlach joining us exclusively as he does every Fed meeting. Right when the Fed chair finishes that news conference, you see Jeffrey Gundlach, and you will continue to do that. Joining me now, Post 9, Ritholtz Wealth Management's Josh Brown. We'll get a quick comment from you before we broaden it out after a break. All right, what do we do?
Well, look, I think Jeff came on in November and he was enthusiastic. And the only thing that's really changed from then until now is we had one of the best 3-month periods in the history of the stock market. We did plus 19%. And quite frankly, we've done that less than 20 times over the last 100 years. The problem for the recession case is that on 16 of those 17 occasions, not only did you not have stocks lower, but you had no recession. And in fact, the market was up an average of over 30% 1 year later. So I would have to hear the case for why this time would be different. If you think we had this $5 trillion rally in the stock market over the course of 90 days over absolutely nothing, that's a really interesting story, because that says to me everyone's wrong and the last people still calling for a recession are right. They might be, but there's very little evidence. Everyone is working. People's bills are being paid. The market seems fine. The economy seems fine. It certainly could change. And I think if we were going to interest rates of 6% to fight inflation, everyone would be singing a different tune. That's not what we're talking about. We're talking about the first cut moving from March to May. to me, it's a very big, no big deal.
Yeah, obviously a bit of a knee-jerk reaction in the market. You stay with me. I lied. We're not going to take a break. We're going to get right to the market zone. And joining us as well, SoFi's Liz Young and CNBC senior market commentator Mike Santoli. Liz, I turn to you. I'll ask you the same question that I asked Jeffrey. Does March really matter as long as we know cuts are coming?
Well, it matters today to the market because everybody seemed pretty sure that that's what was coming.
To the angry algos, maybe. But
Right. Well, I think the other thing about it is that the idea of a cut in March, it was pretty quick, and it gave people this sense that we were sort of invincible because now cuts were on the table. They were going to start. They were going to backstop it. The put is alive again, and we wouldn't be able to go down because they're going to start cutting. So now we're sort of coming to reality of, all right, I think what he told us today was, you haven't been listening. I think Leisman was the one that pointed that out. You haven't been listening to what I've been saying. You haven't been reading the statements. I think he's been pretty clear from the jump, from the beginning of this hiking cycle, that they would rather stay too high for a little bit too long than cut too early. He has not changed his tune on that. The market continued to try to bully him into a different position. And today he said, I will not be bullied. We call the shots.
We're still going to have this debate, Michael, and I think, Jeffrey alluded to this as well, as to whether whenever that cut does come, that first one, which the chair himself called a highly consequential decision, is it going to come for the right or the wrong reasons? Right. Jeffrey's still looking for a recession in calendar year 24. Inflation continues to come down. What forces their hand, so to speak?
Well, nothing forces their hand. And I think the bull case is that they can be bringing rates down just based on their stated framework. Right? Their outlook from the last time they delivered it was they thought inflation was not going to be as low as it is right now, and they thought growth was going to be weaker. So that leaves them room. There's a lot of room in here. What I heard from him sounded like a guy who just kind of didn't have the votes in the room. He felt like maybe we got to wait a little longer. Let's prolong this. I think that's fine. I was saying last week, March to me is not make or break for the stock market, but there are enough people who think March is make or break that you have to clear them out of the market. Let them sell. Clean up the market. We're back to where we were at the beginning of last week in the S&P 500. We're well higher than we were when March was projected as an 80% possibility of a Fed rate cut. We're down below 40. So to me, yep, it's one less thing, I think, that gives you a little bit of a cushion psychologically. And yeah, the longer you wait, the more likely perhaps that you end up making a mistake. And you end up kind of twiddling your thumbs while the economy does buckle a bit. So we're going to know more. I don't think he was going to front run 6 or 7 weeks of growth and inflation numbers and say one way or the other whether it was happening. It was a surprise. He seemed to close the door on it a little more because probably that was the tone of the committee, of the meeting he just got out of.
Let's be clear, too, Josh. We lost the mega cap cushion today going into Powell by virtue of this sell-off that we had already seen throughout the day in most of the mega cap names. Now, nothing was all that substantial except for Alphabet, which was down about 6% or so. But we just didn't have that going into the meeting anyway. So an already fragile market takes a bit of a tumble on the idea that we're going to have to wait a little longer than March.
Yeah, I also think that plugged into the servers that are in this room that we're in are other servers. They're in Weehawken, and they are programmed to make sales of high beta technology stocks if and when Jerome Powell says certain buzzwords. I know it sounds hilarious, but that's actually the truth.
I wasn't joking when I said the angry algos.
No doubt. So we all have seen this now many, many times where tomorrow could be an absolute reversal of today. I can't promise that it will be, but envision, if you will, a scenario where we get the January jobs number, and we will, and that number underperforms expectations, which would be the first time we've seen that in a while. And then all of a sudden it's like, well, maybe Powell was sandbagging a little bit and he just wanted to look at January, February NFP before committing. And we're up 200 points on the Dow, and the NASDAQ has a plus 1.5% day. You're telling me that would be completely out of the realm of possibility? By which I mean to say, don't make today the last and final word on anything, and don't make too much of the reaction that we saw in the last 90 minutes as though that's going to set the course of the rest of the spring.
Big picture, too, Liz. Let's not lose sight of the fact that, as Ken Griffin said on the network yesterday, economy pretty damn good right now. Powell, he underscored it today. This is a good economy, he said, just plain and frank, said that. The employment cost index is coming down. The PCE, Fed's favorite measure, going in the right direction. Inflation expectations, which, get you a ham sandwich and a bag of chips, are still going in the right direction. Big picture, this is working towards where you want it to work.
That's absolutely true. I just think that Powell's bar for satisfaction is higher than most people's bar for satisfaction. And if you heard, I heard the word sustainable path towards 2% over and over and over again today. Their own projections for PCE by the end of this year is still 2.4%. So I also think that his threshold for pain is higher. And if the economy does start to show weakness, I think the market will react to that and say, that's it, we're going to get cuts. We're going to get more cuts than we thought, and maybe rally initially on that. I don't know that that's actually the case. I think that they're quite comfortable with seeing some weakness, almost welcome it in order to get everything back into balance.
You want to take a shot at what Gundlach said, too, about sort of risk assets, whether even in credit, high yield and things like that have looked pretty extended coming into today. So they were right to get picked off.
Absolutely, on some level. I mean, I thought that coming into the year, I was saying that the happiness threshold is higher. You need more good news to feed stocks at 20 times earnings, and after this big run we've had. There hasn't been a 3% pullback in 3 months, okay? One of those could happen for no reason whatsoever. It doesn't take the Fed saying one thing or another. And we're only 2% off the high. So this could just be a process you have to go through that doesn't change the story. If earnings in aggregate are moving in the right direction and the next Fed move is a cut, and the 10-year Treasury yield, by the way, is back to 4%, and you're going to get a little bit of relief on market rates like mortgages, I don't know. It doesn't seem like the wolf's at the door necessarily based on all of those things. Even if, of course, you can chop around after you go up 20% in 3 months.
10-year was at 420 or thereabouts, knocking on the door again 2 weeks ago. And here we are back under 4 at 379, about to hit 378. But you get the point. You could see the initial spike. If we can take that back to the shot we just were looking at, that initial spike right as the statement, there it is, right as the statement comes out, you see at 2 o'clock in the afternoon, just shortly after that. And then you have that drop down and then that rise back up when seemingly the Fed chair says,
isn't it bullish?
About as explicit as he's been to date of no March.
Isn't it bullish that the Fed doesn't feel that they have to ride to the rescue with 25 basis points in 6 weeks? Like, isn't that another way to, all right, maybe stocks got ahead of themselves hoping for 7 cuts. Is it bearish that the Fed only has to cut 3 times? I don't see it that way.
No, I wouldn't see it that way either. And the way I would characterize it is they're saying that the risks are balanced. They're balanced between further high inflation and weak growth. But the risks are low on both those scores. So they're balanced, but they're not high. And so that's a decent place to start. Again, I do think the longer you wait, if you have a bearish view on the economy, if you think private sector job growth is petering out towards 0, and some people actually will show you the chart that say it might be the case, then you might say they're going to end up being a little late, or they're kind of oblivious to some of the downside risks. And maybe that's the case. I don't think it's wound that tight that it has to be that precise, and they better get there by March, and 25 basis points is going to make the difference one way or the other. But, that's the market psychology from this point.
We're dripping a little less than 4 minutes to go here as we head towards the close. I want to set the table for tomorrow. Now that, we're going to digest the Fed throughout the rest of this evening and obviously throughout the trading day tomorrow. But then we're going to get Amazon, we're going to get Apple, and we're going to get these money stocks that still need to perform, especially on the back of what we got from Microsoft and Alphabet. How should we think about all this in the next 25, 26 hours? Because that's when it's all going to go down.
Yeah, I was looking at some of the activity today, and I said, all right, if we're red on these don't wait for March comments, well, what's working? I happen to have noticed healthcare catch a bid. Thought that was kind of interesting. They have secular growth, but they're also still considered somewhat defensive. I was looking at some other areas, and I think what's going to happen here with Amazon and the rest of these names, if you're bullish, you say no matter what they report, if they sell off, the money will come out of those names and go to other places in the stock market. That is a thing that's actually happened before. It happened at the end of 2022, actually, during that October-November period. However, if you get great reports from the rest of the Mag 7 names, but more importantly, you get the right guidance, I think that's enough to keep this levitation act in play. I don't think we have to have the Q1 correction that everyone is now penciled in as sort of a lock. But these names are important, and we shouldn't minimize that.
Maybe the order is going to come back to haunt us, too, in the way that these companies are reporting. biggest question mark, I think, is fair to say coming into the mega cap reports is Apple. You know, given what the revenue growth trajectory has been, and the stock was flat coming into today. Lots of questions about iPhone shipments, you know, casting doubt on that in the last 24 hours by an influential analyst. 2 minutes to go, by the way, an influential analyst over in Asia. We need these stocks now to do well, don't we?
We need their earnings to do well, because so much of the market is looking at their earnings to carry the rest of earnings growth. And we all know these numbers, right? You take the Mag 7 and their earnings contribution versus the other 493, 494 stocks. The other ones look pretty paltry by comparison. So we need their earnings in order to stay afloat. But there would have to be some kind of negative catalyst to really take them down. I think money rotates within sectors for a while until and unless there is a negative catalyst to take it out of the equity market.
Mike, your point that you made a moment ago is so perfectly done, in that we just haven't had this upsetting of a day in a while. So the S&P is down 1.5%. Right. It's the worst day for the S&P since late September. Well, it's been a minute.
Right, which means that you're probably due, if not today and tomorrow, at some point down the road, for a more genuine shakeout and gut check. Look, it has my attention that the Russell 2000 is down 2.3% with the yields down a lot, and the NASDAQ 100 down a lot, so we're not getting that rotational market. To Josh's point, you often get a rethink on the morning after Fed Day, so we'll see how it goes. But yeah, I think you were kind of due for some pruning and a little bit of a let's get a reality check on everybody's perfect macro scenario. But I don't think, again, it has to be anything that consequential. We topped on February 2nd last year. It was a nasty correction. In retrospect, doesn't look like a lot.
All right, so we'll keep our eye on this digestive process, if you want to call it that, until we see again tomorrow, see what this trade does. So we're going to go red, decidedly so. Fed Chair Jay Powell seemingly takes March off the table. I'll send it in overtime now with Morgan and John.
Well, stocks pulling back after Fed Chair Jay Powell said he doesn't think a rate cut in March is likely. The 10-year yield dropping below 4% today, too. That's the scorecard on Wall Street, but the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan with John Forbes.
Yeah, and the NASDAQ, the biggest loser today as communication services and tech weigh on the index. Healthcare, one of the least bad spots. It's like pink as opposed to being red, kind of flat. Coming up, Evercore ISI Vice Chairman Krishna Guha reacts to the Fed's decision and what it could mean for the recent market rally.
Plus, Qualcomm earnings are just moments away. Instant analysis of the results as soon as those numbers are released. But first, let's bring in our market panel. Joining us now, Charlie Babrinskoy, Vice Chairman of Ariel Investments, and Jeff Zervos, Chief Market Strategist at Jefferies. Great to have you both. David Zervos. I was like, this is not right. It's always good to have you on a Fed day. And I think you're really good at breaking down that intersection between the Fed speak we get and the market reaction. So your thoughts on the fact that stocks moved lower or further into negative territory today, largely on that comment. We really saw the drop lower on that comment that March was essentially off the table. Your thoughts?
Yeah, I think, in the previous segment, there was the use of the word bullying. The market had been bullying the Fed. The market had been pushing the Fed. They were putting in relatively extreme numbers for the amount of rate cuts and the timing of those rate cuts. And I think many of the Fed presidents, governors, and the chairman himself have kind of pushed back on that in most of their speeches and most of their analysis. And the market really didn't listen. And I think Jay just said, look, this is kind of what we've been saying, guys. I don't know what you want us to do, but we're not doing that. And, it's just a healthy kind of thing to, I don't see it more as bullying, to be honest. I see it as kind of a child that's gotten a little bit too unwieldy, wants its candy now, is yelling in the grocery store, and the parent kind of saying, you're not going to get your candy right now. You don't need it. You had a lot. And we had to take it away, and we need to be careful with it. So I think they're doing, largely what they said. I think the market got ahead of itself, but really, this is not a big deal. This is a pretty small pullback. The fixed income markets are acting the way they're supposed to, which is kind of hedging equity assets a little bit today, which I like to see that correlation back. And, I think we'll forget about this soon enough. And we'll be talking correctly about, a few cuts later in Q2, and then we'll see how Q3 comes in and Q4 comes in. But as Jay said, this is really about the data. And these cuts are not because the world's coming to an end, Morgan. It's cuts that are really what we like to call